Manish Sonthalia, Senior Vice President and Head of Equity PMS with Motilal Oswal AMC, joins us live. Manish, good morning and thank you for joining us. Manish, what is the right way to look at this current market action? Are large cap stocks looking toppy, or have mid cap stocks rediscovered momentum?
No, I think it is the case of the latter. Mid cap stocks are the favorites for the moment, and they will continue to do so for some time. This space has been hammered down very badly, even though large caps have really not fallen that big. Even there you have a total polarization in some stocks on the NIFTY have actually fallen much more than some of the other stocks. But within the space, I think mid cap should do well, and not only for now, but for some more time to come.
Manish, the interesting trend this series has been, while the headline indices have gained just about 3%, individual sectors have done really well, be it realty, capital goods. A lot of offbeat names have shown up or rather sprung up. Do you think strength is here to stay and the move has only just begun for beaten down names from the cap goods or real estate space, or are these just trading moves that we witnessed?
I think within the real estate space, it is more on, announcements of REITs, real estate investment trust, that you have trading plays being taken in these names. I don't really think anything worthwhile is happening in the real estate space which can be construed as anything positive, So real estate prices mostly in all parts of India are soft to correcting mildly, and especially in cities like Delhi and Bombay, they have corrected significantly. 10 to 15% has been the drop. So I don't really see too much of positive in the real estate space. And again, on the capital goods, is more of a bottom-up approach, which are the names that you would like to pick up. Whether you want to go in for an L&T or a Cummins or a Thermax, etc. These could be some interesting buys, but on a very generic basis, capital goods, again, it's more of a hope trade that things would tend to improve. I think the capex cycle, investment cycle is still about 12 months away.
Right. Manish, if I also look at market internals for the month of December, for the first time we've seen a very synchronized market action. One end, you got real estate index which appreciated by about 8%, and on the other side, you got the IT index which also appreciated by about 7.5%. Are you happy and a bit surprised that the polarized nature of the market is changing now? Because the real criticism for Indian markets for 2013 has been that markets have been very polarized. Is that changing now?
Nikunj, I think for 2014, I think broadly the market should be up. So within that, you'll have all the sectors basically participating. But which are the ones that one would want to bet on? That is the moot question. Where you are more sure about than the other sectors. So I think, something like a real estate or a capital goods, because they have been beaten down and there has been some catch up in prices from the very beaten down levels, or you want to play into something where you're more sure footed, something like an IT. You have the currency tailwind. Now tapering is also announced, so you'll see the rupee depreciate over the next 6-12 months. You have a decent volume growth. America is picking up. So you are more sure-footed in the case of export-oriented sectors. I think at least as far as we are actually positioning ourselves in those sectors like IT and pharma, which are more sure in terms of earnings visibility.
A stock like Infosys is up 50% this year. Wipro, where earning visibility is poor, is also by about 37-38% up. Do you think markets is there a mini bubble in the large cap IT space? I understand why TCS and HCL Tech have done well, but what explains the price action in Infosys and Wipro, where the management commentary is not all that encouraging?
Yeah, so I think in terms of TCS, execution has been far better than the erstwhile Infosys before Narayan Murthy came in, and Wipro again has been lacking in execution as far as comparison with the TCSs of the world are concerned. So that is why you have a lower prices to earning multiples for Infosys and Wipro as compared to TCS, as well as the breadth of the domain expertise which TCS caters to may be slightly different for Infosys as well as Wipro. Again, the mix, how much of a consulting business or how much more consumer discretionary portion of the business does each of these companies have, might be the reason why the prices to earning multiples are significantly different. I think management commentary follows what their business looks like, but I think on a very broad basis, 14-15% dollar revenue growth for the industry per se for the year 2014 looks very much possible. And added to that, if you have something like a 10% currency tailwind, I mean, you're looking at something like 24-25% revenue growth in rupee terms, which is not at all bad. And I think current market multiples are not really that expensive if you factor in that sort of a growth.
Manish, how are you feeling about the pharma end of the market, which again has outperformed quite significantly? What one saw this series was that the gain wasn't quite restricted to the frontliner names, but names like an Aurobindo Pharma, Orchid Chemical, you pick out any mid-cap, and that as well, was on a tear.
So I think, number of these mid-cap pharma companies have a lot of things which is not yet known by the markets fully. So, they are reflecting unpriced in information. So something like an Aurobindo Pharma as to how their US business is going to scale up, that was not really fully understood by the market, and so the re-rating which Aurobindo has given, or something like an IPCA which was lackluster because the FI limit was hit, and as soon as that got withdrawn it suddenly shoots up, or a Natco Pharma where the Copaxone opportunity is there, or an Alembic where numbers are very good. So it's all understanding about each individual pharma company in the mid-cap space, and you have a lot of them. You have an Indoco Remedies which moved yesterday, etc. So I think many of these positives are getting played out. Valuations in these are very, very fair compared to the large cap pharma companies. Opportunities are galore. How each of these companies are able to, take these opportunities and execute properly is what is going to determine what the stock prices are going to be like. I think everything is pretty much known about the large cap pharma companies. There is no element of surprise per se within the export oriented or the domestic pharma companies, something like Glaxo Pharma, etc. So I think opportunity is there. Mid caps will tend to do better than the large cap pharma companies in terms of mispricing of their earnings, which is getting re-rated currently in the markets.
Manish, so let's extend our conversation. Why do you like oil marketing companies? Now, over the years I've interacted with you, you've always maintained that, look, I want to stick to companies which offer visibility. But if you are of the view that you want to buy oil marketing companies which offer value but no visibility, are you looking at changing your portfolio stance?
I mean, these stocks are always there on the radar. What I'm trying to say is that how does IOC's disinvestment go through without any call on the subsidy front? I mean, there will be no takers, right? So, and that is what we have been hearing about in the media, saying that, diesel deregulation is sooner than later, etc. But these things we have been hearing for a very long time. We always knew that these oil marketing companies have tremendous value. If something concrete comes through, then these stocks could do extremely well. That is the point I'm trying to make. And we know that IOC disinvestment has to go through in the month of Jan or Feb. Something has to happen before that, and that would impact the ONGCs of the world. That would impact. We've seen a gas price increase, which is impacting positively both Reliance and ONGC. We've seen a CNG price increase for impacting IGL positively. So, the entire oil and gas space is quite undervalued, so to speak. If we have concrete policy actions coming into place, and visibility will come, should come, because there is no choice for us. It's not a question of whether we want to do it or not, but it's a question of when do we want to do it. So from that point of view, I think the risk is to reward is more favorable for the space at this point in time.
Some other stocks which are springing up quite nicely. Gitanjali Gems, of course, is one such case in point. You've also got names like Monsanto, which are looking good. IGL, of course, we've talked about in great detail. Gitanjali is now holding up about almost 10% there. JSW Steel as well, which is looking to up prices by around 2% from January 1st. So watch out for this one as well. And then, of course, you've got Adani Power, wherein the board is mulling a demerger of the transmission line business on December 28th. That stock as well is holding up by about almost 2% or so. Let's see what the banking pack is up to. Yesterday turned out to be a pretty okay day when it comes to the PSU banking pack. In fact, last series as well, you've seen outperformance come in for the PSU banking pack. Manish, we just talked about oil marketing companies. What about public sector banks? Because most people last 2 quarters had completely shunned this entire space. Is it now time to relook? And if so, would you be selective in doing that?
I think it's time to look at public sector banks more seriously because I think the incremental pace of NPA deterioration is going to be lesser than what we have seen in the previous quarter. So I think come January, when we hear about the December quarter numbers and we hear about CDR cases being less than what it was in the previous quarter, and that slippages have been less than what we have seen in the previous quarter, you could see some re-rating in the PSU banks per se. So, and that could be a change for the better for some time to come. So, because that would mean that bulk of the NPA cycle is seeming to be over. And that is currently not fully priced in the stock prices. So, from that point of view, I think again risk to reward is turning quite favorable, but one has to be quite selective in the PSU names.
Manish, you're really sounding different today, or maybe I'm smoking something strong, because you've never liked PSU banks in the past, you've never liked oil marketing stocks in the past. What's the thinking for 2014 is what I'm trying to understand.
I think these are some of the surprise trades that could play out very well in the new year. Otherwise, it's a run-of-the-mill, your IT, pharma, telecom, which will do well. Consumer discretionary have been doing quite well. These will also continue to perform reasonably well. But what I'm trying to say is that these could be the surprise trades which could reward investors quite positively for 2014.
Let's talk about one stock where I know you have a large exposure, that is Tech Mahindra. That stock has done rather well. It's almost at 1850. Do you think Tech Mahindra still has potential to give you a 20 to 25% return in next 1 year?
I think for the next 1 year, we're looking at a price closer to around 2200 to 2400 odd rupees. So today, if you're talking at around 1850 odd rupees, yeah, I mean, a 20% returns from Tech Mahindra is quite possible within a time frame of 1 year. I think the growth numbers are going to be pretty good. Operating leverage is playing out. They are winning large deals. And, they have an eye on acquisition which could bolster their top line and bottom line even more positively. And valuations are not capturing all of that. I think 12.5, 13 times 1 year forward numbers are really factoring in zero growth. So, plus they have a lot of things to talk about on the SMAC front, social mobility, analytics, cloud. So I think risk to reward is still favorable for Tech Mahindra at this current point in time.
Manish, so far in 2013, it's been a pretty average year, wherein the index has only given you a 6% return. What's the sense that you're getting from now to pre-poll, early May? Because a lot of people are really betting big on a pre-poll rally, and levels of even 7,000 are being talked about.
Yeah, I mean, that's quite possible, and it all depends on what the numbers are like for the third quarter. The results which come out in Jan, and if the numbers are as good as the second quarter, and with the whole poll, the central general elections noise playing around, I think markets could well be headed for a 7,000 on the NIFTY by March, April.
Manish, so are you looking at revisiting your exposure to consumer and some of the FMCG names you own, names like Emami, Glaxo Consumer? Do you think the springtime for these expensive consumer names is over?
They could give you lesser returns than what they have in the past, but I don't think they will give you negative returns. I mean, even for 2014. And if you want to buy into something new, then maybe exposure to some of these names needs to be cut, because at the end of the day we are fully invested, so we have got to get some funds from somewhere. So there could be some tinkering of allocations here and there, but otherwise I think the next 2-3 years outlook on the names which you mentioned is quite positive, and we'll continue to stick with them. But if there is to be an increase in exposure in some of the beaten down sectors or the PSUs or cyclicals, etc., we need to take a call. I think the Q3 numbers are really something which we are looking forward to. Let's see how the thing plays out.
Manish, despite a slowdown in the monthly sales data, autos as a pack as well as auto-related stories like tires have done pretty well. Do you like anything from there?
I think within the autocom space they have done really well, and it is more to do with the replacement demand rather than OE sales. Because last 3-4 years data on the replacement side, whether it be passenger cars or tractors or UVs, they have been LCVs, etc. They have been quite good. So replacement demand, whether it's from the battery side, Amaraja seems to be doing better than X side. Within the tire space, it's all benefiting due to replacement demand and rubber prices crashing. I think within that space we just like Bosch. It's a leader in its category. It has tremendous pricing power. You have Euro 4, Euro 5 norms coming up. They have a lot of localization being built in, so forex exposure, even if rupee depreciates, should not impact the bottom line that much. Last 3 years has been flattish, but whenever growth revives, it's going to be a very big jump in the profits. So we're just sticking with that quality name of Bosch in our portfolios.
You've sold Tata Motors, you bought into Maruti. Now, what's the logic here? Are you optimistic about local demand, and are you bearish about global demand, or are you worried about the capex plans what Tata Motors has in place?
No, I think the concern in Tata Motors is more on free cash flow. If suddenly you increase your capex, where's the free cash flow? Free cash flow goes for a toss. So what was estimated to be a good free cash flow generating machine suddenly sees that it's all about the P&L, and as far as the cash flow statements are concerned, you don't have really free cash flow. So there is a chance that you'll have derating on the prices to earning multiples, and that's the main reason why I have trimmed my exposure in Tata Motors.
So what is the core of your portfolio for 2014? If somebody wants to understand which way Manish Sonthalia is investing, what's the big thought process in place here?
I think we'll continue to focus on export-oriented sectors. I think rupee depreciation is here now, tapering has been announced, so IT and pharma will continue to do well. Telecom should do quite well, so that will also constitute a portion of our portfolio. Consumers maybe will have some reduced weightage, but otherwise they will have a significant place in our portfolio. And banks. And some outliers like a PSU, oil marketing companies, etc., that will make up the bulk of the portfolio.